There is one moment on a chart that traders dream about: the turn. The instant a falling stock stops falling and quietly begins to climb, when fear starts melting into hope. Catching that shift from bearish to bullish is where fortunes are made, and also where the impatient get wrecked. Today you learn to spot the turn carefully and to tell a real one from a cruel fake. First, we need to define what we are turning away from. A downtrend is not random falling. It has a clear signature. Each bounce up makes a lower high than the one before, and each drop makes a lower low. Lower highs and lower lows, stair-stepping down. This definition comes straight from Charles Dow, the father of trend theory, and it matters because the turn is simply the moment this stair-stepping pattern breaks. So here is the sequence of clues, in the order they usually appear, that a downtrend may be ending. Watch them stack up, one by one. Clue 1. The downtrend line breaks. If you draw a line connecting all those lower highs, the price eventually closes above it. The ceiling that kept pressing the stock down is cracked. On its own, this is just a hint, but it is the first whisper that something is changing. Clue 2, and this is the big one. A higher low forms. For the first time in the whole decline, the price drops but stops and turns up before reaching its previous low. Think about what that means. The sellers, who had won every single round, just failed to push it to a new bottom. Their grip is slipping. A higher low is the heartbeat returning. Clue 3. A higher high. The price then rallies up and pushes past its most recent peak, a level it could not break during the downtrend. Now we have the opposite of where we started, a higher low followed by a higher high. The very definition of an uptrend has begun to form. The character of the chart has flipped. Two more confirmations stack on top. The price often reclaims a key moving average, climbing back above, say, its 50-day line, which had been trapped below the whole way down. And volume tends to swell on the up days, telling you real buyers, not just a lack of sellers, are stepping in with conviction. Trendline break, higher low, higher high, moving average reclaimed, volume confirming. That is a textbook change of character. But now the warning, and it is a brutal one, because this is exactly where eager beginners lose money. Not every bounce is a turn. In a strong downtrend, prices often jump up sharply, fooling everyone into thinking the bottom is in, and then resume crashing. Traders have a dark name for this, the dead cat bounce. In the act of buying into a fast-falling stock, betting on a turn that has not actually happened, has its own famous warning. Do not try to catch a falling knife. You will just get cut. This is why the sequence matters so much, and why patience is everything. One clue, a single green candle or a broken line, means almost nothing. It is the stacking of clues, the higher low confirmed by a higher high on rising volume, that turns a hopeful guess into a reasonable read. The disciplined trader waits for the pattern to prove itself and accepts they will never buy the exact bottom. They aim to catch the turn after it has shown its hand, not before. And here, as always, the honest counterweight. Spotting reversals is the trader's high-wire act, thrilling and genuinely difficult, and even the pros get faked out constantly. The long-term investor does not need to play this game at all. By buying a broad index fund steadily, month after month, they automatically buy through the downtrends and the turns alike, scooping up cheap shares during the fear without ever having to correctly call a single bottom. They catch every real turn in the whole market, simply by never trying to. So look back at that dream moment, the turn. You now know its real signature. Not a feeling, not a single green day, but a sequence. Lower low stop, a higher low forms, a higher high confirms, and volume agrees. And you know it's great imposter, the dead cat bounce that lures the impatient onto the falling knife. Read the sequence, respect the fake outs, and remember the calmest investors catch every turn by never chasing one. I'll see you in the next one. Until then, keep it simple and never grab a falling knife.